Welcome. Today, we are going to crack the code on Forex trading. It can really seem like this whole other world filled with confusing jargon. But don't you worry, by the end of this, you are going to have the essential vocabulary down cold. So, have you ever listened to the financial news and just felt like you were trying to decode some kind of secret language? Well, I've got some good news for you. Understanding Forex lingo, it's not about being a genius. It's a skill, and we are going to break it all down together, right here. As our source material playfully points out, learning the lingo is really the first step to mastering any new skill. And hey, who knows, it might even make for some surprisingly interesting dinner conversation. So where do we start? Well, we start with the absolute basics, what you're actually trading. Let's dive in and dissect the anatomy of a currency pair. Okay, so every single Forex trade involves a pair of currencies. The first one you see listed, that's the base currency. The easiest way to think about it is it's the product you're looking to buy or sell. So, in that classic EUR/USD pair, the euro is our product. Simple as that. And the second currency? Well, that's the quote currency. And if the base currency is the product, then the quote currency is basically its price tag. It tells you exactly how much of it you need to pay to buy one single unit of the base. This chart here just puts that whole relationship in black and white. For euro/USD, it's showing how many US dollars it takes to buy one single euro. For USD/CHF, it's how many Swiss francs you need for one US dollar. See, it's always that simple. The base is what you're buying, the quote is what you're paying with. All right, so now that we understand the pairs themselves, how do we actually measure their tiny constant price movements? This is where we get into the real nitty-gritty of pips and precision. So meet the pip. It stands for percentage in point, and honestly, it is the fundamental unit of measurement in Forex. For most of the major pairs, we're talking about a teeny tiny change in the fourth decimal place. Think of it like a single cent in a dollar amount. It's small for sure, but an absolutely crucial unit of change. So, where do you find it? Well, in a quote like 1.2538, it's that last digit, the 8. Every single time that number ticks up or down, the market is moving, one pip at a time. You could almost say it's the heartbeat of the market. Now, for even more precision, some brokers introduce what they call pipettes. Just think of it as a fraction of a pip. It's 1/10 of the value, and it takes the quote out to the fifth decimal place. So the pip is your standard unit, while the pipette offers a much more microscopic view of price changes. Okay, so you can read the price, great, but what does it actually cost you to make a trade? This brings us to three absolutely crucial terms you will see everywhere: the bid, the ask, and the spread. Right, so every trade actually has two prices listed at the very same time. The bid is the price at which you can sell the base currency, and the ask is the price at which you can buy it. And you'll always notice the ask price is just a little bit higher than the bid. And here's exactly how that looks in a real quote. For euro/USD 1.2345/1.2347, that first number is your bid and the second is the ask. This means you can sell your euros at 1.2345 or you can buy them at 1.2347. So why are there two prices? What's that all about? Well, that little difference between them is called the bid-ask spread. It's not a mistake, it's how your broker makes their money. You can just think of it as the built-in transaction fee for your trade. And the math could not be simpler. Your cost, which is the spread, is just the ask price minus the bid price. This is your immediate cost of doing business. And the smaller that gap is, the less the price has to move in your favor just to break even. That's why you'll always hear traders looking for the tightest spreads possible. So using our last example, 1.2347 minus 1.2345 gives us a difference of 0.0002. Since the pip is in that fourth decimal place, that translates to a spread of exactly 2 pips. That's your cost to enter that trade right there. Okay, we've covered the basics. Now let's get into two of the most powerful and, let's be honest, often misunderstood concepts in Forex: margin and leverage. These are the real game changers. This little cartoon from our source material asks a fun question, but it gets at a really serious concept. Leverage is a tool that can dramatically, and I mean dramatically, amplify your trading power. To put it simply, leverage lets you control a large market position with a pretty small amount of your own capital. Brokers offer it in ratios like 100 to 1. What that means is, for every single dollar you put up, you can control $100 in the market. It's an incredibly powerful tool, but you gotta remember, it's a double-edged sword. It amplifies both your potential gains and your potential losses. So how do you get access to all that leverage? Well, the key is margin. Now, this is important. Margin is not a fee you pay, it's a good faith deposit. It's the amount of your own money that you have to set aside in your account to open that bigger leveraged position. Let's just see this in action, okay? Say you want to control a $10,000 position in the market, and your broker has a 0.5% margin requirement. You don't need the full 10 grand. You only need to put down $50. That $50 deposit gives you control over $10,000 worth of currency. That right there is the incredible power and the immense risk of leverage. And we'll end on this fantastic quote from good old Benjamin Franklin. Learning this new language of Forex isn't just about trading, it's an investment in your own financial literacy. And like he says, that's an investment that always pays the best interest. The only question now is, what are you going to do with this new knowledge?